On December 5th, I did a thing. I sold all my stocks for a loss, for a big loss, as in a $30,000 loss. But actually, I did it in order to save money, a lot of money. I'll tell you how. Let's talk money. So this year I actually made a ton of money from the stock market, like a whole lot of money. And well, with making a ton of money, you know what comes with that, taxes. A lot of taxes. So I decided to use a strategy called tax loss harvesting. Tax loss harvesting is a strategy to lower current taxes paid to the US federal government by deliberately selling an investment at a loss in order to use that loss to offset taxes owed to an investment sold at a profit. So in layman's terms, if you've made money from selling a stock that has gone up, you could then turn around and sell a stock that has gone down in order to lower your taxes that you have to pay. Let's take a look at an example. Let's say you were one of the super lucky ones and you purchased 100 shares of the ticker symbol OXY at the beginning of the year at $31. Well, you would now be up 101% for a profit of about $3,100. Now, let's assume that you sold those shares and locked in your profit. Great, but on the flip side, you also purchased 34 shares of Tesla earlier in the year at the price of $240. Its current stock price is $150. That would put you at a loss of about $3,100. Well, now if you would like to avoid paying taxes, you can simply sell your Tesla shares for a loss. Now your tax liability is $0. For me personally, I literally sold several shares of different companies in order to lose $30,000 on purpose. Why did I do this? Well, I make 6 figures a year from trading options. It's actually one of my largest sources of income. And since I've made a ton of money this year trading options, I wanted to lower my tax liability by selling my stocks that were currently down for the year. By doing this, I lowered my tax liability by $30,000. Let me give you an example of this. Let's say maybe I made around $400,000 this year trading options. Well, in that case, I would need to pay taxes on that $400,000 gain. But if I have stocks that are down, in this case $30,000 worth, I can sell those for a loss so that I only have to pay taxes on $370,000 instead of $400,000. But while we're on the subject of options, a few months ago it dawned on me that I have a really good process when it comes to trading options. And I have the results, aka the money, to show for it. And I figure there may be just a few people in this world out there that would love to learn how I do what I do, so I began the journey of creating an online course to do just that. If you'd like to be notified and receive special discounts when this course is available, click on the link below in the description. Now with tax loss harvesting, there is one major rule that you want to make sure that you follow. You want to make sure you wait at least 30 days to buy back a stock after you sell it for a loss. Because if you buy back the shares within 30 days after you sold it for a loss, it will trigger what is called a wash sale. A wash sale is simply a tax rule that prevents taxpayers from deducting the loss when they sell up a security or stock that they replace within the 30 days. So if we look at the example I provided previously, we have the $400,000 made from options, and we sold $30,000 worth of stocks for a loss in order to lower our tax liability to the $370,000. However, if those stocks were to be repurchased within the next 30 days, the IRS would say, nope. We are not allowing you to count that as a loss, and now you'll still have to pay taxes on the $400,000. So make sure you wait at least 30 days. Tax loss harvesting is a way to turn something that is bad into something that is good. However, it does not come without risk. And the risk is, if you sell your stocks, then in the course of the next 30 days, that specific stock shoots up, like by a lot. Let's look at the example that I shared previously with Tesla stock. If you sold the shares for a loss at a stock price of $150, and sometime within the next 30 days, Elon puts out a tweet that says, hey, he's selling Twitter to fully focus on Tesla, and they've begun production on electric airplanes, and the stock suddenly goes up from $150 to $300, well, you just missed out on all those gains. Now, a workaround to this would be to purchase a similar stock to the one that you just sold for a loss. In this case, once we sold Tesla shares for a loss, we could then buy back possibly another electric vehicle company like NIO. And now, if something positive happens in the electric vehicle sector and all the electric vehicle companies see an increase in the stock price, you won't miss out on any of those gains. But you know, maybe, just maybe, you were one of the lucky few that put a ton of money in one of those top 25 best performing stocks of the year, and you don't have any stocks that are down. Great. But for everybody else, time to tax loss harvest. As mentioned before, if you would like to be notified and receive discounts on the upcoming options trading course, please click on the link below in the description. Make sure you subscribe to the channel. Until next time, peace.